Morning, everyone. Thank you very much for joining me. It's the morning market review. My name is Russell Shaw. I'm a senior market specialist at FXCM. My email address rshaw@fxcm.com, and of course, anyone needs to contact me, that's the email to send it through to. And today is Monday, it's the 4th of July, 2022, which is American Independence Day. So there's a public holiday in the US. So there's going to be liquidity, less liquidity in the markets. Just want to do a sound check. Can you guys hear me? Just please let me know if you can hear me. Okay, cool. All right. Just going to bring up the high risk investment warning and our commentaries disclaimer, and we'll get going. Hey, Howard, Rob, Katie, nice to have you all on the webinar. Morning to everyone. Thank you very much for joining. All right, let's just bring up the market commentaries disclaimer. All right, and references. So we'll do most of the analysis market scope. We'll start off with the CNBC European news report, and we'll take a look at TradingView as well. In fact, I'll bring TradingView on screen just while I go through the CNBC morning article. And the headline reads, European markets are set for a positive start to the new trading week. European stocks are expected to open in positive territory on Monday in what's expected to be a quieter day for global markets given the July 4th holiday in the US. Global markets are settling into trading in the second half of the year after the first half, dominated by concerns over inflation, the war in Ukraine, and the potential for a global recession ended last week. There are signs markets in Asia are struggling for direction. Overnight, Hong Kong stocks fell in Asia Pacific markets. Overnight, Hong Kong stocks fell as Asia Pacific markets were mixed on Monday ahead of Australia and Malaysia central bank decision this week. As US markets are closed for the 4th of July public holiday today, trading volumes are going to be much thinner. Last Friday, US stocks rose at the start of the new quarter after the S&P 500 closed out its worst first half performance in decades. There are no major earnings or data releases in Europe on Monday, apart from Spain's latest producer price index for May. All right, this Friday, just by the way, this Friday is going to be non-farm payrolls. So we'll have a live trade. Okay, so live trade and a live account on Friday. I'm just going to put the link in the chat so you guys can register if you'd like to join us for that. It's in the chat. Yeah, Katie is just asking if we can do Nasdaq and oil. We certainly can. I just want to keep an eye on this this top chart that we have here. So we introduced this last week. This is the US 10-year yield, less the break even. So we're looking at real interest rates. So you can see that the real interest rates are positive, but they have pulled back somewhat. The bottom chart here is the US dollar. And what we will do is we'll just add the correlation coefficient onto the two. And I think this is a good way to keep an eye on the US dollar. And okay, we can see we've got a really strong correlation coefficient here. It's at it was over 90, I think, last week. It's dropped to 0.89. Still strong. What's going to be interesting is if we clear out the dollar, clear out the correlation, and we just change this to just the US 10-year. All right, so you can see a lot of movement in the 10-year here. So this is This is very interesting. We reached a high here of about 3.5, right? And we've come back to 2.89, 2.89, yeah. All right, so the obvious question here is, the top chart here is the US 10-year. Is that the one you're asking? Before that, we had the US 10-year minus the minus break even. So we had US 10-year minus break even. So what we're effectively doing is we're adjusting for inflation. We want to see what the real rates are. Okay, so that's this guy. Okay, that's this guy. What we want to do is we want to just keep an eye on the 10-year, because there's a question here, and it's an important question. And it's have we seen the sort of the medium-term high in the 10-year? So and that's an important question, because if the 10-year has peaked, what does that mean for US dollar? Does that mean US dollar has potentially peaked? And if US dollar has potentially peaked, what does that mean for the rest of the markets? The dollar is the first link in our chain of causality. It's worth throwing in a RSI here. And the reason it's worth throwing in the RSI is because we were overbought. So the question is this a technical correction? Is this a technical correction, or are we truly seeing rates having peaked? To be honest, I'm actually not quite sure. I think there is a chance that we may have peaked in rates. And the reason that I think that we may have peaked in rates is I don't know if the Fed will be willing to be as aggressive as they've indicated, given that the economy is starting to capitulate. Okay, Katie just asking if we take a look at this on the monthly. Yeah, so let's take a look at this. We'll go from daily. Let's go through to weekly. Okay, here's sort of the weekly, showing some sort of froth that's come down as well. It's worth also just talking about this RSI in a moment. Let's just take a look at the monthly. Monthly has corrected here, KD. So let's hit this 350 and pull back. Interesting candle here on the monthly, isn't it? It's a an inverted hammer. Okay, but let's just go down to the weekly. And this pattern over here is actually quite interesting. It's quite a failure swing. If you kind of just Google failure swings, I wouldn't give it any more importance than anything else, but a failure swing is just effectively, take a look here. You just apply trend analysis to the RSI. You're going to have something like this. You're going to have a peak. You'll have a trough. Okay. Then the next peak is a lower peak. It does go into the overbought area, but it's lower than the previous. Okay, so you can see where the failure swings, and then it takes out the trough. Okay, so this is, and what's the big deal about a failure swing? It's usually seen as some sort of signal. Again, I wouldn't be too dogmatic about it. For me, it really, does the RSI stay above 50 or doesn't it? That to me is more important. In fact, the failure swing here is just showing a divergence. Okay, so that's sort of interesting. Again, to me, I'm not too not too impressed by that. It's more about whether we hold above 50 or not. So let's just keep an eye on this this 10-year. Have we peaked, or is the Fed going to be is it going to retain its aggressiveness? And I think that's something that we need to keep an eye on, because it's going to have an effect on the dollar, and the dollar has the I guess the weight of the causation. You know, once we get the dollar moving, that's the cause. Everything else is kind of an effect. So we just want to keep an eye on this. Let's take a look at the US 2-year. Okay, so the US 2-year is more closely aligned with the monetary policy of the Fed. So let's bring that up. Okay, and it's also dropped quite dramatically. Okay, and what we'll do here, we'll just throw in the Fed funds rate. So this is what we did last week, but it's worth, I think, keeping an eye on this. So let's add in the Fed funds rate here. All right, so the Fed's still behind the curve according to this. Okay, so it's still behind the curve. You can see that the Fed funds rate follows the US 2-year quite impressively. Again, I'm going to throw in a correlation coefficient here. So what we're looking at is the correlation between the US 2-year note and the federal funds rate. And you'll see the correlation coefficient here is, by and large, a very strong positive. On the odd occasion, it diverges, right? On a very odd occasion, it diverges. We'll just keep this monthly because the Fed funds rate will move monthly. All right, so the idea here is if we see the US 2-year, so there's two scenarios here. Okay, there's two scenarios here. So the one scenario is that the 2-year moves in towards the Fed's funds rate. That has happened. That happened here. So we have to go all the way back to 94, where it was the 2-year that overshot, and then that's where the correction took place. It pulled back towards the Fed funds rate. I don't really see much evidence of that happening, perhaps slightly over here, and again, perhaps slightly over here, but nowhere near as severe as going back to 1994. And the question is, are we going to get some sort of pullback here in the US 2-year, or is the Fed funds rate going to carry on marching higher, or are they going to meet in the middle? Okay, so we want to just double check. And I was asking what happened in 1994. I can't quite recall any. I can't quite recall any crisis happening in 1994. I think the Asian currency crisis came sort of 3 years later. So perhaps this might have been just some sort of anomaly. I'll have to go back and see what happened, but I can't quite recall any real shock at this stage. But what I think may happen, is we kind of get sort of perhaps a meeting in the middle. In other words, the Fed still has to increase rates, so I think that's a given. No, 95 is a bit early for the dot-com bubble. It's a bit early, Sam. Dot-com happened more sort of round about this over here. Here's the dot-com battle, right? So it's sort of a, I can't quite, there was a currency crisis somewhere in the 90s. So okay, Anna's found the 1994 bond market crisis, or the so there we go, the Great Bond Massacre. All right, interesting. I'm going to come back to that, and I want to give that some thought. I think that's actually probably has more bearing than I gave it credit for. We'll have to come back to that. Let's just go back to 2022. So I think that the Fed funds rate has to move up, but perhaps some sort of moderation, perhaps, I don't know, in the 2-year yield, with already some sort of indication that we may have seen a high on the 10-year. And what that may suggest is we may have missed an inversion on the yield curve. So let's just take a look at that. We're very close. Let's just go to the weekly. Gee, we're 5 basis points away from an inversion here. All right, so we'll just keep an eye on that. Okay, so the reason we want to keep an eye on the inversion here, okay, is inversions always precede recessions. They always precede recessions. So we just want to keep an eye on that. We don't quite have the inversion yet. And that I think is interesting with all this talk of recession. With all this talk of recession, the 10-2s haven't inverted yet. So I noticed that they haven't inverted yet. So we just want to keep an eye on that. And the fact that the 10 years seem to have perhaps peaked, you know, it's kind of got me thinking. All right, we just want to keep an eye on that. Let's go back to that US 2-year. I want to go back to what Anna's written here. Yeah, it's fascinating. All right, hold on 1 second. All right, let's bring back in that Fed funds rate. Okay, there we go. Let's bring in the Fed funds rate. All right, let's just make this a little easier to see. All right, so we've got here 1994, September into 1995. All right, so Anna, right, so 1994 bond market crisis or Great Bond Massacre was a sudden drop in the bond market prices across the developed world. It began in Japan and the United States and spread through the rest of the world. I just want to do a little bit of study there myself. I'm begging your pardon, but I think that she's hit the nail on the head. I just want to do a little bit more research. I'll come back to you with it tomorrow. But let's just think about it. The Great Bond Massacre. What are we saying there? What are we saying about a Great Bond Massacre? Okay. What are we saying about a Great Bond Massacre? We're saying that the price of bonds are coming down. If you're holding bonds, well, the value of your bond is effectively getting murdered, right? And that's what a massacre is. Unless you're holding the bond to maturity, okay, you are probably going to experience capital losses there. Okay? That's kind of what I garner from that. Now let's go through to IEF over here. IEF is the exchange traded funds for 7 to 10 year treasury bonds. Okay, let's bring that up. Okay. Unfortunately, we don't get it all the way back to 1994. But if I had to ask you, all right, guys, where's there evidence of another massacre here? Well, you don't have to look past the last 12 months, right? Here's a bond massacre right here. Okay, so seeing the bond massacre in 2022, taking a look at Anna's note, can we draw parallels? And the answer to that is possibly, you know. So the fact of the matter is, if we've got a bond massacre over here and the US 2-year has overshot, perhaps that's what's happening here. Again, I need to do a little bit more research on that, but the point being that maybe yields have overreacted, given that there is this huge fear of recession. Perhaps we've seen the peak. Perhaps the central banks have to pull back, and we've seen PCE already moderating somewhat. We've still got to see it on the CPR side of things, and I think that's what we've just stated now. That's the story for this quarter. Okay, the story for this quarter is there some sort of repricing in terms of just how aggressive the Fed can be. Okay, so with that all said and done, let's take a look at the US dollar. All right, and we're looking at the weekly chart of the US dollar, and you can see that it's gone overbought. Okay, it's overbought on the RSI. Now, this to me is interesting. It's gone overbought at a time when there seems to be a shift in thinking from inflation to recession. So inflation pushes the US dollar up. Okay, that bias in terms of the economic argument supports dollar. What about recession? Does recession support greenback? And I think the macroeconomic variables change hugely when we start talking about recession over inflation. So the fact that we've gone overbought here on the US dollar at a time when there seems to be a shift away from inflation towards recession, again, that's our focus for this quarter. Okay, we've now gone into the third quarter. We are talking recession, okay? And then the idea here is, well, are we going to get an inversion on the yield curve? So what kind of got thinking? Very good question from Rob last week. You know, are we perhaps being overly bearish? Now, I don't know. I don't know. But that's kind of that's the food for thought here, right? That's the food for that's what we're trying to assess. Let's just now take a look at the US dollar on a okay, so we're still in zone one, and because we're in zone one, any sort of support levels will be something that we would want to keep an eye on. But at some stage, I would expect this weekly overbought condition to resolve, to normalize. But what's the underlying fundamentals that would need that to normalize? There would be some sort of shift in narrative away from inflation towards recession. The interesting thing here is, I think we may be caught between a rock and a hard place, where the narrative is going to sort of swing between these two themes. It's going to swing to recession, then swing back to inflation, then swing to recession, then swing back to inflation, because unfortunately, we're in a stagflationary environment, which is an abnormal economic condition. Stagflation, the last time we had stagflation was in the 70s. We haven't seen it for 50 years. So the idea here is not, so we're very much in an abnormal environment. And I think because we're in this abnormal environment, the narrative is going to shift very, very quickly. And that shift in narrative is going to disrupt us in terms of our trading. So this past quarter was really good because we just had to focus on the inflation narrative. Okay, once we focused everything on the inflation narrative, all the puzzle pieces kind of fitted together quite nicely. Now we've got to try and be quite, I think, savvy and figure out if that's still the narrative. Let's just go to our economic model, and then I'm just going to do demand supply, and then we're going to go look at DAX, oil, Nasdaq, and then we will conclude. But let's just understand the confusion in the economic environment. Okay, so I just want to do this again, just to get an idea of just how confusing the situation is. Okay. Now let's put our two narratives on the axes. So the one narrative is inflation. Okay, and let's put recession. It's not quite the right way. Let's call it economic activity on the X. It's better. Okay, economic activity. Whereas if the economic activity moves to the left, that's recession. If it moves to the right, that's expansion. Okay, and we've got something called full employment, which is sort of the ideal full employment, which doesn't mean everybody's got a job. It means that everyone that should have a job has a job. There's a natural rate of unemployment. Okay, and then within the limit of full employment, you've got markets at work from both the demand side and the supply side. Okay. Now let's just put these in. Sorry about the spelling there. All right. Now there's been a supply shock in the first half. Okay, that was because of the war in Ukraine, the invasion of Ukraine, and that supply shock means that a lot of supply has been taken out of the circular flow of the economy. It's not the only reason that supply has shifted. The other reason was that China, which is a major economic powerhouse, as an engine, right, where it had extremely strict lockdown conditions as well. So we had these shift in supply. A lot of supply is taken out. When I say supply is taken out of the economy, goods and services are becoming scarcer. If they're becoming harder to get, then they're worth more. Your inflation increases. Okay, so just take a look what happens here. where your supply equals your demand, so if they're standing there, you've got inflation level 1, okay, and you are at full employment, but because of the supply shift, we know that inflation has shot up from 1 to 2, okay, and you're getting contractionary pressures, okay, because we're off this theoretical full employment level, okay. So that's the first thing that we're dealing with, okay. That's the first thing that we're dealing with. Now, supply shocks are very rare. That's what we're talking about when we talk about stagflation, is from the supply shift, okay. Last time we had such a severe supply shift was in the 70s, okay. Now, this part over here, the demand side, okay, this is where your policymakers operate. So this is your monetary policy and fiscal policies. That's where these guys operate, on the demand side. They're not on the supply side, not on the demand side. Now, think about this. We think about it in 2 steps. Think about this in 2 steps, right? We've got first step, supply shock. Supply shock shifts supply out. Result, higher inflation, recessionary pressures. Okay. Second step. Okay, so that was the first step. Second step, interest rates start moving up. Interest rates start moving up. What happens to demand when interest rates start moving up? Let's change colors here. Demand has to come down. Demand has to come down. Okay. Now, the reason that demand comes down when interest rates go up is not very difficult to envision. Just think about it in terms of your own credit card. Okay. When your interest rates go up on your credit card, you know, you want to try and control the amount on it a little bit. I guess be more disciplined, strict about it. Same thing goes with business. Same thing goes with any economic activity, because interest rates going up requires more discipline, more restraint. So why would you want to be putting your interest rates up? Because you want to shift inflation back from 2 back to 1. That's what you want to do. You want to get back to 1. Okay, but where are you on the economic activity scale? You're at the lowest you've ever been now. So what does that mean? It means that there is a trade-off between inflation and economic activity. That's stagflation. That's why the narrative is so difficult to nail down, because the first half was all about the narrative of inflation. The second half is that. Now, this is a question mark. We don't know. Is that going to be about economic activity, aka recession? Okay. If it does, okay, then there is potential that this curve can't come back like this. It maybe has to moderate somewhere in between. Okay. Has to moderate somewhere in between. Okay. Which is very, very different to pulling all the way back and killing all that economic activity. So we in this weird flux between narratives of inflation and economic activity. That's our project. That's our agenda. That's our objective for Q3. All right, because it has very different economic dynamics, very different cause, very different effect. All right, let's go through to our chart. Let's take a look at the DAX. All right, so at the moment, DAX still under pressure. So you can see lower peak, lower trough, we can see that the stochastic rolling over, okay, so the support hasn't really found its feet. Well, let's say the bulls haven't found their feet, but we're at the support level. It's a better way to say it. But of course, we still are in zone 3. Okay, so, and we've still got this bearish momentum, and because we've got that, it's the resistance areas that are going to be of interest. Now, this over here on the hourly is a very interesting looking hourly chart. Let's just take a look at it. Remember that we've got a lack of liquidity today in the markets. Got a lack of liquidity in the markets. The technicals may not act as sort of smoothly, but what kind of pattern do we have here? You can see it's a 2-3, isn't it? Some sort of rising wedge or flag, or there's a 2-3. 1, 2, 2, 3. Do we get the push down? Okay, that's the question mark. And then of course, here's trigger 1. Trigger 2 is already pulled. Okay, but it's got to get to the low quintile if there's going to be any sort of opportunity there. So that's the DAX. Let's just take a look at Nasdaq and oil. Go to Nasdaq first. Now, Nasdaq is very interesting because of the huge focus on the inflation narrative. Nasdaq is the index that's taken the most stress. It's been absolutely hammered. But if there is a swivel from inflation to recession and dealing with recession, in a strange sort of way, Nasdaq might be a beneficiary. So again, that's part of the agenda, part of the objective of Q3. Are we moving in that direction or not? Okay. All right. Until we get further evidence, we do see lower peak, lower trough. All right, we do have a rollover here, and we are neutral. But of course, if the stochastic rolls over and goes through to 20, we'll probably get a movement down to the lower quintile. The obvious statement to make here is it's American Independence Day. The liquidity here is going to be thin. I'm not sure what kind of a movement we're going to get on Nasdaq. You know, even this activity on DAX probably going to be thin as well. But we'll keep an eye on this. Right now, it's in the neutral position, but longer term trend is down. Let's go through to UK oil. And let's take a look at US oil. All right, so this is part of that supply shock. Peak, trough peak, higher trough, higher peak. Still looking for the higher trough here. So I wrote an article last week asking if we were going to get this higher trough, and we would have got the higher trough if we had closed above the aqua horizontal. We didn't get that. In fact, we got a sell-off after the OPEC Plus meeting, right? The oil chart at the moment, it has fallen into zone 3, but it's tried its best, I guess, to move from zone 3 to zone 2. Let me ponder this. I think, Katie, it's a difficult, this is a difficult analysis to make because we don't have this higher trough locked in. So what happens if we get this big sell-off? Maybe the higher trough comes in here. Maybe it becomes a lower trough. I'm not sure. What I think we need is a close above this horizontal here just to give us a little bit more bullishness. Failing to do that, I think we fall back into zone 3 here. Very difficult chart to read in my estimate. I'm going to default to neutral here for the time being. Again, I'm going to tag on that subject to correction. I'm sorry I can't be clearer than that, Katie, but it's not an easy chart to read at the moment. Let me know if that helps. All right, I think that's a good way to start the week. We've started the week, we've started the quarter off. We want to just see where the emphasis falls. Does it go to inflation, recession, inflation, recession? It can't be both, okay, because there's a trade-off in stagflation. Stagflation is an abnormal situation. We're finding ourselves in this abnormal situation. With the abnormal situation comes trade-offs. Now comes down to policymakers. Where do they want to make their mistake? On the economic activity side or the inflation side? Any questions, guys? All right, I'll take a look into that 1994 bond crisis. Thanks for that, Anna. Nothing coming through. Oh wait, I might have missed something. Okay, cool. All right, let's wrap up here, and then you guys have my email. We'll chat tomorrow. Today probably going to be quite a slow day, one would expect, with the American 4th of July celebration. Thanks very much, guys. Chat to you tomorrow.